My name's Sid Mendelson. I'm Director of the Division of Investment Management. On my right is Dennis Gertz, Examination Program Coordinator for the Division. Dennis will speak of the capital requirements for the public offering of investment company shares. Go ahead, Dennis.
Section 14A sets a minimum net capital requirement of $100,000 before an investment company can make a public offering. Keep in mind that this $100,000 amount was set in 1940, and if you were starting off today, it would be considerably higher, $500,000 or $600,000, $700,000, $800,000. $100,000 today is not the barrier to the entry into the industry that it was conceived as in 1940. It was felt in 1940 that if a company could raise $100,000 on its own in a non-public offering, then there was at least 25 people or less that had some confidence in the ability of the manager to manage his money before he was let loose on the public. The ALI code revision that's currently being worked on and going to be submitted to Congress shortly, I believe, proposes a revision in this section to $300,000. This was a compromise. I think originally they wanted to have $1 million. There were a lot of people that objected to that, so it was $300,000 was better than nothing. Specifically, Section 14A1 requires that no public offering can be made unless there's a minimum net worth of $100,000 raised in a non-public offering for investment purposes. This means that the money must be left in there for some period of time. Generally, we look at, if it's been in there for at least 2 years, that's defined as investment purposes. Concentrate on net worth for a second, underscoring the word net. This has had a couple of different definitions, and basically I'd like to see a company that had $100,000 of investable assets before they were being able to make a public offering. At times, though, various circumstances have resulted in companies with a lot of offering expenses being deferred until after a public offering has been made successfully, and then the liability of the investment company. If you look at the balance sheet footnote, you'll see that they have, while they have $100,000 cash, they may have a contingent liability for $50,000 if there's a successful public offering, but that means that they will have raised $500,000, $1 million, or 20 or 30 million. Some companies handle this $100,000 differently than others. You can file a registration statement without any financial statements in it. It can't be made effective, however, under 14A1 until you actually have the $100,000. But you could go through your filing, have all the comments reflected, then put your $100,000 in, and go immediately effective. Remember, one fund hate to call them amateurs, but it was a reason that this section was there. They scraped together $100,000, put it in a bank account, drew it out, and started to invest it while they were going through the registration process. The securities lawyer wasn't all that sharp, and they kept having problems, and a month went by, and 2 months, and 3 months. Pretty soon their $100,000 in a very bear market was now worth about $75,000. Pretty soon it was about $60,000. They put more money in to get it up to the $100,000. They kept it invested. They kept losing money. They put in some more money, and it kept going down. They never went effective because their $100,000 was never there. They never could keep it in long enough. The moral of that story is don't show people what you can do until you're effective. 14A2 says that if you've previously made a public offering, if this company had already made a public offering, and at one point in its public life it had $100,000, you could have made another public offering with less than $100,000. If they'd had $75,000, they still could have kept it invested or gone effective.
Of course, the registration statement and the prospectus would have to show the investment record of the fund. And if the investment record of the fund had taken it down below $100,000, the chances of having a successful second offering may be somewhat remote.
There's Section 14A3 gives you an out here. Let's assume personally or the manager doesn't have $100,000 that he has lying around. 14A3 says you can go completely through the registration process without any financial statements and without the $100,000 being in the fund's assets. However, as a condition of the offering or the effectiveness of the registration statement, there's an undertaking that they will not make a public offering until after they've raised in, I'll call it a non-public offering, but it really is still a public offering, but a limited public offering, raised the $100,000 from no more than 25 persons, very similar to the 14A1 requirement. The staff has viewed this as being investment money, however. It's in a different category than if it was in a true public offering. And we've asked that in some cases that letters of intent be submitted by the underwriter indicating that the 25 persons plan to leave the $100,000 in the fund. Mechanically, it's declared effective. The original registration is declared effective, say 10 a.m. in the morning. They have an effective prospectus, and these non-public public sales take place. The auditor is right there. He watches the $100,000 go into the bank. He certifies the statements showing $100,000. They come back in with a post-effective amendment showing a balance sheet having $100,000. That post-effective amendment is then declared effective, and they're off and running in a true public offering. Several rules under Section 14. Rule 14A1 allows the use of a Reg E filing by SBICs, small business investment companies, if it appears in the Commission's view that the SBIC will be able to comply with Section 14. That is, they will have the $100,000 from less than 25 persons. Otherwise, it's very similar to the 14A3. The money if they can't raise $100,000, the money has to be returned within 90 days. Rule 14A2 exempts certain tax-qualified variable annuity contracts from the requirement of having $100,000 in at all if the sponsoring insurance company has a capital and surplus of $1 million or more. Most insurance companies, if not the vast majority, will qualify for that. These are only 403B plans, so not all tax-qualified plans are covered under this section or the rule.
I might say that in figuring how de minimis the $100,000 is, that the ICI, the Investment Company Institute, recently, within approximately a year ago, estimated that for an open-end, a mutual fund, that the assets to make a viable company would be $40 million. So you're talking here in terms of $100,000 to start. Hardly viable. In 1962, people said that it would take $10 million to make a company viable. So inflation here has taken its toll also.
Rule 14A3, the last rule under the section, is brand new and exempts qualifying unit trust from the $100,000 requirement altogether. I think most unit trusts, the bond funds of various kinds, will all be able to qualify very easily for this requirement, so there will no longer be a need for the sponsoring underwriter to put in $100,000 of his own money and leave it in there for an extended period of time.
There are certain qualifications under that rule, the theory being that, as I explained the unit investment trust to you in the bond for bond funds, before the assets, before the public offering really commences, the fund or the unit investment trust already has either has the securities deposited in it, or or has commitments that the securities will be put in within a certain number of days. Consequently, the $100,000 in assets are really already there. In fact, the assets are much more than $1 million. And what happens, as I said before, is that commencing the public offering is a technicality. The depositor, the promoter, Merrill Lynch, for example, puts the shares in. He takes back all of the units. Now that is an underwriting, probably commencing a public offering. Then, from his own, having owned those securities for purposes of public distribution, he then sells all those units, and all of the money that he gets is his, because all of the securities that consist of the portfolio, he has given to the fund in exchange for all of the units, which he will then sell. So the technicality of the public offering beginning when he pushes in those units is only a technicality, and the rule to a large extent merely recognizes that as a technicality and gives relief for that. There is no need. There's no need at the time that the first public investor is touched with these shares, with these units. There is much more than $100,000 net worth in the portfolio. Go ahead.
Just to comment on that, wrap it up. The 100,000 has become so de minimis. I think you can see the series of rules that are getting away from anybody even having to have the 100,000. When the legislative history looked at the $100,000 as providing enough money, and it appears from a quick reading that it looks like they were talking about an internally managed fund, to actually have enough money to start operating, hire several analysts and a secretary and a president, and set up an office and everything else. Well, $100,000 won't buy you more than a couple of months of activity at today's rates. Any questions under Section 14? Okay. Move into Subchapter M. Is that okay?
Yes, sir.
This is moving away from the Investment Company Act for a few minutes. We'll talk about Subchapter M of the Internal Revenue Code. This is covered under Sections 851 to 855 of the Internal Revenue Code. Advantages of qualifying under Subchapter M are really one very significant one, and that is that it eliminates the double taxation of the shareholder of all the income that his shares are earning in the investment company. And this is done by eliminating the taxation at the corporate level, assuming all the income or the vast majority of it is passed through to the shareholder. Now, there are four main tests that have to be met in order to be qualified under Subchapter M. And once you qualify and elect to be taxed under Subchapter M, as long as you do qualify, you must handle it in that fashion. That is, passing all the income through to the shareholder. The first test is the 90% test. This means that 90% of the gross income, disregarding losses, must come from dividends, interest, gains on the sale of stock, and since 1976, put and call premiums from option writing, and more recently, 77 or 78, money received in lieu of dividends and interest when a fund loans the securities. Pretty much anything an ordinary investment company is doing now qualifies under this 90% test. As recently as 76, that wasn't true. There has always been funds that have been writing options, and there have always been funds that have been loaning securities, and they've had to been very careful to make sure that they don't exceed the 10% of their income from those sources. Second test is a 30% test. This is no more than 30% of the income can come from gains on stock held for 3 months or less. This again can be a problem for certain types of funds. Specifically in the late 60s, go-go funds that were rapidly turning over their portfolio would have had a real problem meeting this test, and did have a problem. Option income funds today have a problem if they're not careful in allowing too many of their short-term holdings to be called away from them through the exercise of options they've written. And municipal bond funds, the new ones, can have a problem because they have very little taxable income, and the only taxable income they're going to have is from the capital gains on the sale of their portfolio holdings, and if too many of those are sold before 3 months, it could have a problem. The fourth test is the diversification test, and this is related but not identical to the Investment Company Act definition of diversification. You can be a non-diversified company for the 40 Act and still meet the diversification test under Subchapter M. Specifically, as to 50% or more of your assets, or as to 50% of your assets, no more than 25% of the total assets can be invested in a single company. So you could have two holdings of 25%. And as to the other 50, or the restricted 50, no more than 10%, you cannot have more than 5% of those assets in any one issuer, and own no more than 10% of the outstanding stock of that issuer. So the 5 and 10% rules are the same under the 40 Act as they are for Subchapter M. They track each other. Some companies still fail to meet this lesser standard of diversification. If you remember back, the 40 Act, to be diversified, it's 75%, so you can only have one company of 25%. The other 75% must be meet the 5 and 10% rules. Okay. The fourth test is the registration test, and this means you have to be registered under the Investment Company Act of 1940. There's a minor exclusion for certain common law trust funds that I've never seen applied. We have had a situation in the past where SBICs especially have wanted to register under the 40 Act simply so they could qualify under the Subchapter M and be taxed with the pass-through treatment. We have taken the position that an SBIC or any other company, that for that matter, that doesn't have to register, that is, it doesn't have more than 100 shareholders and it's not making a public offering, cannot gratuitously register under the 40 Act solely to qualify under Subchapter M. There are only about 40 registered SBICs compared to the maybe 1,000 that are out there. Another requirement is that at least 90% of the ordinary income of the investment company must be distributed to shareholders. If you meet the 90% test, any ordinary income that is retained would be taxed at normal corporate rates. I guess they're 48% now, basically. That's very rare. You'll rarely see any investment company that doesn't pass through 100% of its ordinary income, and that's mainly because there are there's numerous provisions under Subchapter M that counts dividends that are paid in subsequent months after the close of your fiscal year against the previous year's income, so it's very easy to meet that test. Capital gains, on the other hand, can be handled in one of three ways. They can be distributed to the shareholders just like the ordinary income, in which case the shareholders report the income on their own tax returns as a capital gain, and it would retain the character that it was in the hands of the fund. If it was a long-term capital gain by the fund, it would be a long-term capital gain in the hands of the shareholder, regardless of how long he owned the shares of the fund. You could buy them tomorrow and there could be a distribution of long-term gains. He'd pay tax at long-term capital gain rates. Similarly, if it's a short-term gain, it doesn't matter how long you've owned the fund, you'll be taxed at ordinary income rates. Distributing it to the shareholders avoids any taxation at the fund level. The second way of handling a capital gain is the fund would pay corporate capital gain rates, which are currently 30%, and it could retain the gain. Shareholders not involved at all. His net asset value for that year would go down by 30%. Hopefully this was accrued for. I mean, the fund wouldn't decide at the year end that it was going to retain the gain. Very few funds operate in this fashion, but you do see it occasionally, especially in a closed-end fund. Third way is the fund pays a 30% tax and then goes through what they call designating the gain to the shareholders. That is, the fund would get a slip of paper saying the dividend is, or the capital gain distribution is $1 per share, and on your behalf we paid 30 cents. The shareholder would report the dollar of long-term capital gain on his own tax return, pay whatever the tax was at his tax rate. Presumably it's going to be less than 30% because now 60% of the gain is exempted from taxation, and so if he's in a 50% bracket, he'll be paying much less than 30. Even if he's in a 50% bracket, he'll be paying much less than 30%. He gets a credit then for the 30 cents that the fund paid. Actual tax credit. So if he's if he pays no tax, he'll still get a refund for the tax credit. So this is just more complicated for the shareholders, and you rarely see it. Occasionally, for generally other reasons, you'll see it, but it's fairly rare. Any questions so far? Some miscellaneous comments. You may see in rare instances a company that looks like a mutual fund that's not currently qualified, and it may choose not to qualify because it may have an operating loss carry forward, which can be offset against all the ordinary income of the fund until that loss is used. If you qualify under Subchapter M, you lose the ordinary income carry forward. I'm not sure the kind of situation you'd see this in. It might be in a personal holding company that switched over and for some reason had a more extensive holding and stopped being a personal holding company, but they may not choose to qualify or elect the qualification until they've used the carry forward. A fund may also not qualify under the diversification rule, but still look like an investment company, and indeed may be registered under the Investment Company Act. An example of this would be Christiana Securities. They held a very substantial portion of DuPont, and it was indeed started to control DuPont, or maintain the DuPont family control. They paid a penalty for this, though, by not qualifying under Subchapter M, because they did not. 98% of their assets were in DuPont shares. There's an 85% corporate dividend exclusion that all corporations have, including a non-qualified investment company. This means that 85% of all the dividends that they receive from DuPont were excluded from their income, so they're only paying the corporate rate on 15%. So in effect, they were paying a 7 or 7.5% penalty for not qualifying under Subchapter M, or as a penalty for the other business reasons for having Christiana Securities in existence.
But on the other hand, Dennis, had there been no Christiana Securities and DuPont would have paid those dividends directly to the fund, those dividends would have been taxed at 100%.
Well, they would have been taxed to the shareholder.
Yeah,
the DuPont shareholder.
And since this was only, they actually filtered this tax through Christiana, and saved approximately 80% of their taxes.
They could have, I guess. DuPont, I guess Christiana was not required to distribute the earnings, so they could have accumulated it. You're right. I've never noticed that before. They could have accumulated it within Christiana Securities for an extended period of time without passing it through. But I think the way it actually operated, Christiana was paying dividends to their shareholders. and therefore the shareholder then would pay tax on it again. So I mean, the way it actually worked, there was a 7% penalty. As you may be aware, these other business reasons diminished over the years, and DuPont and Christiana were much more widely held. I mean, the Christiana shares were traded also, and the dispersion became such that it wasn't necessary. It became an albatross, a luxury they didn't feel they needed anymore. And eventually, after going through an extended hearing proceeding at the Commission and all the way up through the Supreme Court, there was a merger between Christiana and DuPont, where the DuPont shares were passed back, or actually, I guess Christiana merged into DuPont in exchange for new DuPont securities. So you don't see that anymore, and shareholders income would have increased ever so slightly. Mentioned before the advent of the municipal bond fund. Tax-exempt interest in a corporate form, starting in '76, was allowed to be passed through to shareholders and retain its character as a tax-exempt income. And this is when you started seeing all the municipal bond funds in a corporate form. Previously, you'd seen them in a unit trust. The trusts were taxed differently and were viewed as the individual holders were viewed as the owners of the trust assets. So in that situation, the interest always passed through in a tax-exempt nature. As long as, in a corporate form, as long as 50% of your assets are in tax-free securities, at the end of each quarter, you qualify for this treatment. Another minor point concerning an individual's dividend exclusion on his tax return. As you may be aware, you could not pay tax on $100 of dividends on an individual return. The dividends from an investment company will qualify for this treatment if at least 75% of its own ordinary income came from dividend income, in which case 100% of its dividends would qualify for the treatment. If it's less than 75%, if you've got an income fund that is invested mostly in bonds, for instance, only that percentage of the fund's dividends which are represented by dividend income qualifies for the exclusion. This carries over also for corporations owning the fund share. To qualify for the 85% exclusion completely, they have to meet that 75% test. Otherwise, a portion of it would be taxable and not eligible for the exclusion. And finally, there's a very good article in the Notre Dame Lawyer, the October 1966 issue by Kern, which obviously is a little bit dated now, but goes through Subchapter M, which it runs over 50 pages in greater detail, and is a very good treatment. Any questions? Okay, shall we go into section 32?
Yes.
Okay, moving into another financially related section, back into the Investment Company Act, we'll cover section 32, which is the selection of the accountants and auditors. And this, like the bonding requirement, the minimum $100,000 requirement, the disinterested director requirements, whatever, is a requirement that's put into the Investment Company Act is for the protection of the investor. I mean, this is a very fundamental protection. You've got a very independent source coming in and reviewing the books and certifying the financial statements.
This is what I call really a badge of protection. We started with Section 8A, and we discussed the protection of the investors through the requirement that the company state its policies clearly, that it designate which of those policies cannot be changed without shareholder approval. And now we have another, what I call badge of protection, the selection of independent auditors. I'm sure you've heard a lot about independent auditors, independent accountants in corporate governance, But I think one should keep in mind that the framers of the 40 Act had recognized the necessity for protection through the independent auditors, first here in the 40 Act, and the use of independent accountants here predated, I would say, Stan Sporkin's campaign for responsibility of accountants.
Specifically, the requirements are 32A1. The accountant must be selected by a majority of the disinterested directors, voting in person at a meeting called for that purpose during a specified time period. And at one point I thought I was confused on this issue, but I found out later that the section itself is confusing. And specifically, the way it reads now, you have a 60-day window at the beginning of the fiscal year. This would be 30 days before the fiscal year starts and 30 days after the fiscal year has started. So it's 30 days before to 30 days after the beginning of the fiscal year. So if you're a 12/31 company, you have from the beginning of December to the end of January for the board to meet and select the accountants for the coming year. I think it's desirable to have the accountants selected at the beginning of the year, because then they're on notice that they're going to be auditing the fund. They can perform certain tests during the fiscal year. They can review the quarterly reports and the semi-annual reports, and they have a much better understanding of what's going on in the fund. If you haven't selected it during that 60-day period, there's another 30-day time period, and that begins 30 days before the annual meeting of the shareholders. So if your annual meeting is in June, for instance, for a calendar year company, you'd have the 60 days at the beginning of the fiscal year plus the month of June, for instance, if the meeting was on June 30th, for the board to meet. But because of that, if you don't have your annual meeting at the beginning of the year, there could be a dead period in which the board may not be aware that it could not select the accountants from a technical reading. This is recognized in the ALI code, and I think they're providing for a 30 days before to 120 days after the beginning of the fiscal year. 32A2 says after the board has selected the accountant, that selection has to be ratified by the shareholders at the next annual meeting. Very straightforward. The accountants work for the shareholders. This is goes way back to the 40 Act. I think it's fairly common now for the shareholders of most corporations to approve the accountants, but it wasn't always so. And I would point out that I think it's very infrequent that the shareholders, and I've never seen it, where the shareholders would not ratify the selection of the accountants. If a vacancy occurs between the annual meeting, or between annual meetings due to a death of the accountant, if it's a sole practitioner or a very small partnership, or a resignation, then that vacancy may be filled by a majority of the disinterested directors, voting again in person at a meeting called for that purpose. And that would be ratified at the next annual meeting of the shareholders. Most very rarely see a vacancy occurring because most of the accountants are large partnerships now, and the death of a single partner wouldn't change their engagement.
There have been occasions, however, when an accountants have resigned, and this brings up we have always insisted, in fact, we have always inquired as to the reasons why that accountant resigns.
I think it would be inappropriate, it's not specifically stated, but I think it would be inappropriate for the board to act on its own and ask for the resignation of an accountant after it's been ratified by the shareholders. That
is correct, but sometimes because of a disagreement on how an accounting problem is to be carried or is to be handled, the accountant will, in exercise of his professional judgment, resigned from the assignment.
Right. At the end of this section, I'll cover how that's covered under the N1Q requirements now. Going back to 32 itself, 32A3 states that the engagement letter or the contract with the accountant must provide for the right of the shareholders by majority vote to terminate the accountant's relationship with the fund. I've never seen this happening. This would mean that the shareholders would have to meet and vote to terminate the accountant. But they have that right. 32A4 is another unusual requirement. This goes back to the beginning of the 40 Act also. That the CPA's opinion must be addressed to the board and to the shareholders together. It's really very unusual to see any kind of opinion directed to the shareholders themselves, but this again, I think they wanted to make sure that everybody realized that the accountants in a mutual fund were working for the shareholders and not the management company or not the directors. Now, if an accountant is rejected by the shareholders under 32A2 or is removed under 32A3 by a shareholder vote, shareholders can vote at that meeting for a replacement or at a subsequent special meeting. But they again would have to vote for the replacement. 32B moves on to another topic covering face amount certificate companies and requires that the approval by the shareholders or the board of directors, specifically of the specific people that are charged with the preparation of the financial statements of the face amount certificate companies. I was talking to Sid yesterday on this. It wasn't real clear to me right away why this was, and Sid points out that this was probably because the reserves in a face amount certificate company are very important and are subject to a great deal of management interpretation as to what the appropriate reserve levels would be. And that the person determining that would be the chief financial officer, and it would be appropriate to have that person selected specifically by the board and or the shareholders. 32C gives the commission the right to adopt a rule that would require retention by the accountant of all the work papers that were employed in the audit of the investment company. To date, they have not had any such rules, although I think it's standard practice for an accountant to retain his work papers for an extended period of time. It also in 32C gives the right for the commission upon an order to have the accountant produce those records for the staff. So it gives a legislative power right here to obtain the work papers of the investment company. Any questions?
Generally speaking, in an inspection, it is not unusual for the inspector, if they have a problem on how a matter was handled, either in the net asset area or something of that sort, to request the work papers of the accountant. While it isn't an everyday occurrence, when a problem comes up, we usually ask the investment company if it has any objections for us to look at the work papers of the accountant. I am not at all certain whether we have to ask permission, but we have, generally speaking, asked permission. Obviously,
they've been very cooperative.
Yes, it's a rare. It would be very rare for the investment company to refuse to allow us to look at the
or the accountant.
Or the accountant. Well, the accountants are a little more reluctant until they get permission of the investment company, because there is no rule or order to the effect that we have, quote, a right to them at this time. If obviously we felt it was necessary to look at them and they were not forthcoming voluntarily, the chances are the regional office or this division would request an order of investigation and subpoena those records in order to determine whether a violation may have occurred.
I have a question.
Yes, sir.
Since it's been written in the papers now, and many attorneys have challenged the commission in requesting documents from them when the commission is investigating companies for allegedly violating social security laws. And these attorneys have claimed privilege with respect to these documents. I was wondering, in the discussion of Section 32, whether the commission has encountered accountants claiming accountant's privilege with respect to records that have been made in auditing investment companies.
Yes. Generally speaking, the accountant's privilege is not recognized throughout the 50 states. Several states have an accountant's privilege. I think, and I'm not sure, but I'm almost sure, that the federal government at the present time does not recognize an accountant's privilege. I don't know of any federal court. Now, this may be an error here, but I am not sure that any federal court has recognized an accountant's privilege. Obviously, the attorney-client privilege is now recognized on behalf of corporations, which previously there was some dispute on. But with respect to privileges, we have always, obviously, when you inspect books and the privilege is asserted, the inspector must go back to his superiors to determine what course of action should be taken. Generally speaking, where the attorney-client privilege has been asserted in inspections, we ask for an accounting, if you will, as to what documents are being the privilege is being asserted, so that they have to give, so that we insist that if they're going to, if a company asserts the privilege, we want an inventory of the documents that the privilege is being relied upon, and in that way, merely because a company asserts the privilege, as you know, doesn't mean that the privilege is appropriately asserted, and we may well want to challenge that as something that does not come within the privilege. For example, suppose you have an attorney that's a member of the board of directors, and as part of that board of directors, he says something in the room. Query: is he saying it as a board member, or is he saying it as counsel? We've had that problem in several instances, and that poses the problem of the danger of an attorney for a company sitting on his board, because at that point one doesn't know in what capacity that he may be acting at the time. So mere assertion of a privilege is not necessarily recognized by the commission. The mere assertion does not necessarily mean that the company has a right to assert the privilege. Also, as you probably know, as you should surely know, the privilege can only be asserted by the company and not by the attorney. So that when a privilege is asserted, I usually ask that the board of directors, by resolution, assert the privilege. The attorney can hold back those documents until the board acts, but the board asserts the privilege, not the company. I also think what you're discussing, possibly what you've read in the papers, is the new law with respect to subpoenaing bank records. The bank. Well, I'm no authority on that. As you probably know, the commission has a temporary exemption. I think the way the act goes is that when the commission subpoenas bank records of an individual, the individual must immediately be informed and would have the opportunity to object. The previous law said those records belonged to the bank, and they were the bank records, and that the individual had very little, if any, right to suppress those records. The present law in Congress, in which the commission is exempt, seems to recognize that these records are jointly those of the investment of the person as well as the individual, as the banks. Normally, we don't have that problem. With respect to inspections, the record we have interpreted our inspection privileges very broadly, and we have not been challenged really seriously on that.
We'll get into that exact point on the books and records section, which comes in a later time.
Go ahead.
Back to, I've never seen on your specific question on accountants anyway, I've never seen a privilege assertion being made, so it's not been a problem. There's two rules under 32. 32A1 states that a Section 10D company, that is a no-load company that qualifies under 10D and only has one disinterested director, shall have the whole board approve the accountants. Otherwise, you'd have just one individual making the selection in many cases. Rule 32A2 provides an exemption from the initial shareholder approval by certain variable annuities, provided that the accountant is approved at the next annual meeting of the contract holders. This is just a procedural thing to make the variable annuity operate more efficiently. It doesn't require a separate meeting. More fundamentally to this section of accountants is the whole thrust of increasing the independence of the accountant so that he can really be, if you will, a badge of protection. While the 40 Act, as Sid said at the outset of the section, was ahead of the game, it's been beefed up in two specific areas outside the section itself, but have given the accountants a lot more independence and a lot more ability to require that the financial statements reflect what the accountants feel should be in there. Specifically, the proxy rules under the 34 Act require a statement as to the existence of an audit committee of the board of directors. This mere statement as to whether a committee exists has in fact created the committee in most situations. Most funds and most corporations now have audit committees because they don't want to have to say specifically that they don't have one. And the proxy rules also require a statement as to whether the accountants will be in attendance at the annual meeting as shareholders. Again, this has resulted in a situation where the accountants are now always in attendance at the board of or at the shareholder meetings and available for questions. Finally, and really most fundamentally, the N1Q that I alluded to before, item 10, requires, as of several years ago, a notification of a change of auditors. And when the auditors change, and it doesn't matter if it's between the two premier accounting firms in the country, it still requires a letter from the fund stating the reasons for the change. Okay, might be fees were less with the other one, or who knows what the reasons are. But if there was an accounting disagreement, then it has to be spelled out in the letter. And backing that up, there's a requirement for a letter from the replaced accountant, that is the old accountant, stating whether he agrees or disagrees with the letter of the fund. So it really gives him a club. It'll be public knowledge why he was fired or why he was replaced. And that gives him a great deal of power to make sure that the financial statements are what he believes in.
It also puts us on notice that there might be a disagreement, and therefore our inspection machinery may go into operation at that point. We're cognizant. We start inspections in a great many instances when something isn't working smoothly. This is our early warning system, so that we will send a crew in, even though our regular schedule may be 4 years, the cycle may be 4 years. That isn't to say that we wouldn't inspect a company possibly 2-3 times in one company, 2 or 3 times in 1 year. That would be an unusual situation, but we never worry about the cycle when we have a necessity to go in. There are certain things that will trigger it. One of them would be a disagreement with respect to an accountant and the fund as to how something should be handled.
Should be a particular red flag if a large accounting firm is replaced by a local non-name firm. That generally means that there may have been a major problem with the larger firm that the smaller firm is willing to go along with just to get the audit fee. Finally, item 10 of the N1Q is related to this. It requires a letter from the accountants and a statement by the fund if there's a change in accounting principles. This would be fairly rare, if not very rare, but it also puts the accountant on the hook and gives him a forum for expressing his views very specifically, even if it didn't affect the overall fairness of the financial statements. I think that about wraps up Section 32 on accountants.
There is one item I'd like to mention, one little item in Section 32, which sometimes is missed. And Dennis may have touched upon it, but if he did, I can't recall. And that is that when the accountants certified the records, it's made both to the board of directors and to the shareholders of the company, meaning, as I interpret it, that the shareholders, as a matter of right, have the right to see the audit and see the statements, just as much a right as do the board of directors. And while this may or may not be important in the general run of things, in a specific area where there is a shareholder disagreement with the board or dissident shareholders, it could be very important. We only got 7 minutes left.
On that one point, I notice Frank Dalton in the audience is looking up a registration statement for a unit investment trust that was going effective today. And I want to point out there's an exception area. You have to look back at the very beginning of 32A. It only covers registered management companies or registered face amount certificate companies. For some reason, unit trusts don't qualify for this protection.
I would say this also, in the N1R, the annual report for investment companies, the auditors there have to certify as to the internal controls of a company, whether they're working and whether there is a system of internal controls. This is very important as far as I'm concerned, because most of the violations that take place under the 40 Act take place because the internal controls of the company have broken down. And we'll get into that a little later, but I think that's a most important thing. And the advent of the N1R and its certification as to internal controls
In detail.
in detail really brought the accounting firm's responsibility to the fore.
That's been reinforced by the Foreign Corrupt Practices Act, which makes it basically illegal for any company not to have a good set of internal controls. And apparently all investment companies are subject to that act just like all other corporations. So that's a good place. If you read any part of an N1R, that's the section to read if you're looking to see if there's going to be a problem. Because it's a long report and has to itemize any weaknesses that are in existence and how the accountant and the company are going to rectify them. Any other questions?
If not, we'll break.